Hello and welcome back to Dukascopy TV. We hope you're all enjoying a fantastic Easter weekend. But don't worry, as we're still bringing you all the latest on the FX markets, including a look at what to expect this trading week in the Week Ahead interview with my next guest, Alvin Tan of Societe Generale. Alvin, with bank holidays across several major markets in the week, does this indicate a slow performance week with low volume and less liquidity? How will traders have priced that into their trades?
Yes, we are likely to see lower trading volumes, but this year's low volatility and a weak trend environment, especially in G10, has already resulted in lower volumes in the currency market. And clearly, when volatility is low and trends are weak, market participants don't trade as much. They don't need to. In terms of what those traders who are looking to trade will be doing, particularly if there is a sizable trade to be done, that would basically mean working the order more gradually into the market, so some patience is needed if they are looking for the best pricing.
Wednesday sees China's HSBC manufacturing PMI data. While the flash reading tends to have the greatest market impact, how does market reaction from the latest GDP figure allude to the scrutiny this reading is going to be placed under?
Well, both the Shanghai Composite and the Hang Seng indices are both about 7% off the lows of the year. And their reactions to the Chinese GDP data that was out recently was actually quite muted. Shanghai Composite, in fact, closed higher on the day of the Chinese GDP data release. So we can say that the Chinese market has already priced in an economic slowdown to some extent, and growth at 7.5% or so is a consensus view now. Now, the consensus estimate for the April HSBC flash PMI reading is currently 48.5, so a number in the 48 area would spark a major market reaction. Given market expectations of a Chinese slowdown, a higher number in the flash PMI could actually be the bigger market mover.
Also on Wednesday is the release of the BOE's inflation report. With UK inflation falling below the BOE's 2% target 3 months in a row, are we set to receive indications of tighter monetary policy?
No, not at all. First of all, as you mentioned, the UK CPI inflation has already fallen well under the 2% target, with the latest March reading showing inflation at 1.6% year-on-year in both the headline and core readings. So secondly, the BOE has already modified its forward guidance policy in February to consider a wider set of economic indicators apart from the unemployment rate. So all in all, the BOE is in no urgency to tighten policy. But we do expect the first policy increase by the BOE to occur in the first quarter of next year.
And lastly, looking at US data, core durable goods orders are set for release on Thursday. Are we still likely to see remnants of poor winter weather in these figures?
No, the effect of the winter weather has passed in the US data flow, so what we get on Thursday should be free from the weather distortions.
Thanks, Alvin. That's all from me. Thank you for watching.